Someone once said, we're not in the storage business in the trading game. We're in the moving business. We want to move from one good situation to another. And if it's not a good situation, you have the ability to get out and move on.
That was Price Headley, president and founder of BigTrends.com. Hello, everyone, and welcome to TradeStation and another edition of our Trader Interview Series. My name is Michael Burke. I'm Vice President of Client Training here at TradeStation, and today we're very privileged to welcome Price Headley. Price is a veteran trader, author, and educator. He's the founder of and CEO of BigTrends.com and author of the book Big Trends in Trading. Price is a featured speaker at seminars and symposiums all over the world. You can often see Price commenting on the markets on CNBC, Fox News, Bloomberg Television, and of course Price hosts Morning Market Briefing for us here at TradeStation. Price, I really appreciate spending this time with us today.
Hi, Mike. Always a pleasure.
So Price, tell us a little bit about your background and how you got started trading in the markets.
I'm originally from Lexington, Kentucky, where I'm kind of born and bred into the thoroughbred horse business. And so when I was actually a student at Duke University studying to be pre-med, basically pre-vet, to be an equine veterinarian, stay in the thoroughbred business, I was having some challenges with that side of it, and then I got into this trading contest that was an AT&T national contest with something like 14,000 students, and thought, well, I'll try this out and see how it goes. And I took kind of the Warren Buffett approach. It was a 4-month contest, all paper money, of course, to get started. But after 3 months, with a month to go, I got my statement, and I was in the bottom quartile of all the, quote, investors of this college contest. I said, it might be time to try something different. This little kind of buy and hold approach is not working for me. This is back in the late 80s. By the way, so it was kind of a time where people weren't talking about active trading that much yet. And I just started reading the Wall Street Journal, and I started day trading, actually kind of scalping against these sort of takeover rumors that look like a bunch of hype, that I thought I could kind of scalp it back down and see how that approach worked. And I went from the bottom quartile to the top 1% in the month of February in less than 30 days. They even sent me a letter saying they hadn't seen that much of a comeback in such a short period. And I told my dad, I said, I think there's something here. I'm going to actually switch majors. And Duke didn't have a business major, but I switched to economics and kind of got into the whole financial side, took their investing and other classes through their business school, and really got hooked on the whole world of trading, reading the journal, reading just everything I could get my hands on. And so that was really kind of the start, if you will, of the real passion that I had for active investing and trading.
So who were your mentors in those days?
Yeah, I was really fortunate because, actually when I got out of college and graduated from Duke, I went on and initially became a broker because there weren't any jobs that I was looking for in the analyst side around Kentucky. And so basically I went to Cincinnati, Ohio after a brief stint as a broker and got a job as an analyst with Bernie Schaefer's firm, and basically was with Bernie for the entire 90s for 9 years there, and had a lot of great experiences learning about options, learning about technical analysis. Bernie taught me a lot about contrarian thinking, understanding kind of what the rest of the crowd's doing and how you don't want to align yourself with the rest of the crowd per se, but which kind of, it's an interesting dichotomy with most people think trend following is just following what everybody else is doing, but there's a lot of trends that people will fight, and you'll see a lot of various ways you can tell if the general crowd believes in an uptrend and is committed to it essentially with their dollars, or if they're actually fighting it, and then there's even more opportunity in that trend. So it's a nice way to sync up technical analysis with that sentiment and contrarian analysis. And then just basically was constantly absorbing as much information as I could, and was really blessed to learn from people like John Murphy, his technical analysis kind of Bible, if you will. Larry McMillan and the Options as a Strategic Investment is the first really great options book that I read, and just so many other folks I've had the pleasure of learning from, including John Bollinger and his Bollinger Bands, which were kind of the starting point for the indicator I developed called acceleration bands that actually helped me launch Big Trends in '99. So just really, I've always viewed it as a kind of a standing on the shoulders of giants mentality of really, be remiss to not also mention Larry Williams in there, because I found his percent range indicator very useful actually for really strong trending phases, kind of using it in a little bit of a contrary way at the really extreme ends of the overbought and oversold spectrum. So there's just so much there. There's so many great teachers, so many great traders out there, and folks to learn from, and I view it like, hey, just continue to kind of advance where a lot of great research has already happened.
Yeah, those are all great names, very similar to the way I started trading. You really can't get much better than that.
Agreed.
So Price, give us an idea of your trading philosophy and how you generate your trade ideas every day.
Certainly. So I'm very technically driven because I believe that, fundamentals obviously matter in the long term, for long-term investors, and certainly can be put as an overlay against short-term trades you make. But I really do believe that technical analysis, the price action, and the technical indicators that you want to use really should drive your short-term decisions. It's a much more rational way to take a short-term active investing approach because you've got clear data all the time. You're not letting somebody else's opinion or your opinion potentially bias what you're actually seeing happening on the chart where the money's flowing in or out of a given situation. So what I do is I follow those technical signals. Of course, I use TradeStation. I've been using it for 25 plus years in various forms to go find information, find data. And frankly, with the data that's out there, you need to have something like that that you can use to really sort out the best of the best opportunities that you want to look at. So for me, I use, for example, the TradeStation radar screen technology to really sort out from hundreds of different active optionable stocks and ETFs to show me what's best position right here, right now. And whether you're looking at more technical breakouts, some of the methodologies I've developed to actually then find little what I call retests, the retracements, if you will, within a proven trend so you can put on a trade at a level where if you're not going to see that level hold, you can get out very quickly. I've always said it's okay to be wrong, but don't be wrong for long. That's what most traders and investors, frankly, mess up on is they hold their losers far too long. They take not only too much price risk, too much of a hit too much of the time, but also they get stuck in these sideways, non-moving situations where you think, well, I'm not getting hurt on that, but actually you're giving up opportunity. We call it opportunity cost, that you could be doing something else with that money and growing it better or at less risk somewhere else. So we want to continue to kind of rotate around. As someone once said, we're not in the storage business in the trading game. We're in the moving business. We want to move from one good situation to another. And if it's not a good situation, you have the ability to get out and move on to something else. So we think of that moving business as important as an active trader when it's not working. And then, but I'm generating these ideas more on the stock side first, and then I'm using fairly simple option strategies, whether it's more of an in-the-money option to basically control that stock for a limited period of a week or two or three. Why buy the stock when you can lease it with an in-the-money option for a small fraction of the cost of the share. So to me, that's a great way to go if you want to just take a directional approach. Or of course, we also have other less directional required strategies like credit spreads and things where you can be generating steady income by selling, an out of the money credit spread, for example. But that's probably beyond the scope of what we're talking about here. So, the important thing is to get the underlying right first. To me, gives me a tremendous edge. A lot of people think you can't time the market, and I'm glad to hear that because that means that there's still opportunity there as long as you, have a systematic methodology for seeing when you have an edge. Most people make the mistake too, Mike, of assuming that they're going to be all in. They're going to be really right or really wrong. And the thing is that it's a probability game. Even on the best setups that I find, even if I am right, for example, say half the time, you'd think, well, that's not a good system. But actually, if you can lose really small and win many multiples of what your risk is, that can be a tremendous system being right only half the time. So to me, a lot of people misunderstand that and just think that the number one metric is what's your winning percentage. But I know, for example, traders that win 80% of the time and still lose money because on the 20% that they lose many multiples of their average win, right? So basically, that size of average win to size of average loss is a very important concept that a lot of people sort of skip over when they're looking at evaluating how successful any trading approach is. So to me, it's that combination of win percentage and size of win to loss that really goes together to form, what kind of an edge you have or don't have. And the other interesting thing too, Mike, is that, I've been trading now for like 27 years. It's interesting that we're always finding new idea flow and new things we can test and see how many of them work. And the irony is that you'll have a great idea, you test it, and then it doesn't give you enough of an edge to make it worth replacing what we currently have in place or even worth pursuing further. So the good thing is you can get rid of a lot of the noise and kind of focus on basically the small minority of your trading ideas and concepts that are really worth pursuing as an ongoing system and approach. So it's been a work in progress for me for a number of years, and I consider it's always going to be that way because I always want to be taking the Lee Iacocca quote, I'd rather be green and growing than ripe and rotting. You know, we always want to stay sharp, never assume we've got it all figured out, even though we have a nice systematic approach. We want to always look for that next edge, that next thing we can add in to further enhance returns for our subscribers.
I couldn't agree more. Maybe you could go in a little more in depth on your approach to trade management and risk management, maybe both on an account level and on an individual trade level.
Sure. Well, you know, it's interesting because, you know, when you start with the account level before you get into individual trades and you think, okay, whatever your number is you're starting off with on a trading account, I mean, we always recommend people start really small. The absolute maximum that we'd like to see people risk on a given trade as a percentage of their portfolio would be actually around 2% of their portfolio as a worst case kind of a risk. So this is where I start to tell people who are just getting into the trading game, if that's the case, you might need to avoid certain situations like, say, trading right in front of earnings where you have the potential for a big gap, not just in your favor, but a big gap against you, which takes your ability to manage risk off the table. You know, we want to try to actually kind of avoid those gaps in most situations. The only way I would even consider that for a newer trader would be to say maybe if you had a trade on weeks in front of an earnings report, you took a good portion of the trade off, you've gotten your risk capital back in your pocket, then you could take a flyer on the remaining, few contracts or what have you, if you really have a strong opinion about an earnings reaction. Because I've just seen too many cases where people think they know what's going to happen on earnings, but guess what? A lot of Wall Street knows that company's going to report good earnings, and then the good news actually gets sold into, and the stock's down on good news. So you've got to be careful about just making assumptions. That's another kind of classic beginner's mistake that a lot. I'm sure you see it too, Mike. That people come in saying, "Okay, the news was good. I bought call options, thinking the stock's going to go up. Why did the stock not rally on such great news?" And it's just it's an expectations game. That's where that sentiment piece and seeing what everybody else is doing. If everybody's buying calls right in front of earnings, you should be very worried that is a very kind of overloved situation that's going to get a sell the news phenomenon. And so anyway, long story short, for the 2% risk of the account, then you start scaling back to say, okay, then you have to think about, okay, so if you were investing, say let's just take a really simple example, $10,000 account, you're investing $1,000 in a trade, that'd be 10% of your total risk capital. That would only be acceptable if you can keep your individual trade risk at a 20% loss or less, right? Because if you take a 50% loss on a trade, then an option trade, that's certainly very easy to do if it gaps against you. Well, then, if you invest 10% of your capital, you lose half of, you just lost 5% of your portfolio on one trade. That's too much. So basically you would need to invest less if you think it's got that kind of ability to move against you. Especially if it's more than a one-off event, if that's happening to you more than just on one, quote, bad break. Bottom line is that means you got to take matters into your own hands. See, a lot of people, when they get into trading, they're attracted to trading for, of course, the financial freedom that it can potentially offer, the ability to be your own boss, a lot of great things. But I always tell people is that not only are you the CEO of your trading business, but you're also its chief employee if you're getting started on your own. And you've got to be accountable to, losing trades out quickly and saying, look, if I were the CEO looking over at the employee saying, is the employee doing his or her job to cut these losers out quickly and move on? Then basically, if not, you need to kind of take a step back and say, okay, maybe I'm investing too much, or maybe you're just trading too fast and furious without getting a sound system and plan in place. So again, it's one of those things where you're competing against people that do this all day, every day, and if you're saying, okay, if you're just getting started in the game, make sure you're putting the energy into getting well educated in front of applying your hard-earned dollars into the market. That yes, we want you to trade successfully. We don't just want you to trade for activity's sake. We want you to trade with a probabilistic edge where you can expect to get results over time, knowing that any one trade or series of trades can go against you. If you can stick it out through that kind of risk managed approach, you'll be able to be in the game for the longer haul. If not, you'll just be one more of the plungers that just tries to go in too hot and heavy, and eventually those people, even the smartest on Wall Street, get blown out for either trading too big of a position size or, more importantly, letting their risk management go, letting a trade go against them and letting it end up blowing them up. So basically, we don't want to ever put any trade in that kind of position to make that kind of a dent on us. We want to take it more of a steady approach where we can say, okay, yes, we're not going to hit massive home runs on the overall portfolio in any one trade, but we're also not going to have massive strikeouts either.
That's really good advice. Just on a side topic here, I know that you trade stocks and you trade stock options, but you also trade futures as well. Maybe you could just touch on a little bit, what you're doing in the futures markets.
That's where it goes back to what I was mentioning before about this retest concept of this retracement. So for me, one of the biggest, I think, challenges when you see a technical breakout, and you're like, that's a good looking breakout to the upside, is that, if you're using leveraged instruments and you're kind of, to some extent, chasing that breakout, that, a normal retracement with a highly leveraged instrument can cause you a lot of pain and a lot of problems. And what I see, and I see this with all types of traders, experienced or not, that if you put the trade on at the wrong level on a risk-reward basis, you oftentimes will get yourself stopped out even when the structure of the trend is still in your favor. And to me, that's kind of frustrating, right? To be right about the overall trend, but to just be whipsawed by some little noise as it retraces. So I would rather pick it up on one of those retracements. And so we have very certain patterns of big trends that we teach people about: a percent R retest, the Larry Williams indicator, or the commodity channel index, CCI indicator, other retests that we found that are particularly good at saying, if we're not right, we can get out real quickly because we're going to get stopped if it violates a key low on an upside breakout, or same way on a downside move, if it get a retracement back up, we'll put a stop just over that high. Bottom line is that, okay, so I'm going to be wrong small, and I may actually, that may even hurt my winning percentage a little bit. It might take my winning percentage a bit under 50%, so that, I might, if I'm winning even 35 or 40% of the time, you say, gee, that doesn't sound good to the average Joe that wants to win 80 or 90% of the time. But the reality is that for those more growth-oriented systems, if you keep your losses small, if you lose 100, you lose 100, you lose 100, then you make 1,000. That's a pretty good system. So basically, if you're able to, not just keep your losses small, but of course, then you have to have the second skill, which is to be able to ride when you're correct. And a lot of people, I see this too, Mike, that a lot of people from either the bear market of '08 and the Great Recession kind of mentality and what happened to people through that phase, or just in general from their own trading prior experiences where they were trying to do it themselves and making the classic mistakes and then losing. A lot of people get real gun shy from those kind of experiences, and that fear factor is still with them as they make trades. So then when they start to make a little money, they say, well, they heard the old Wall Street motto, you can't go broke taking a profit. So they think, well, I've got a quick profit, I'll go ahead and take it. And they don't even give themselves a chance to have a bigger trend success, even on part of a position. I always tell people, look, if you're really prone to wanting to book profits, maybe just sell part of your position and then trail your stop underneath it. Give it a chance on some of it if it's a trend trade to run, because those are the ones that make your system and your method when you're more of a trend trade focused system. So from this perspective, I see the fear factor causing people to do both things of letting losers run and then cutting their winners short. We all know that the old Wall Street maxim is actually, cut losses short, let winners run. But most people are actually doing the opposite because of those fears. And of course, it's the hope factor on the losses that makes them hold on too long and hope that it'll get back to break even. And that's another, obviously, deadly trading behavior. So bottom line is you've got to have a way to get out of your own emotional kind of scar tissue, I would call it, your past baggage of your past trades. So when you're working a new system, so just give it a chance to do what it's supposed to do. Follow the signals. And that's, again, one of the things I love about the clarity of when I get TradeStation buy and sell signals. It's right there. It says buy, I need to buy. It says sell, I need to sell or get out if it's an exit. So bottom line is that, you first have to teach yourself the discipline to take those signals, and because your ego is going to fight that. Your ego is going to say, we don't need a system. We're smart. We can do this ourselves, right? And the ego constantly wants to sabotage any efforts that you make when you're starting to install the discipline of trading a system. So that's going to be one of your first kind of psychological battles, is controlling the ego. And that's why I tell people maybe you need to start with either a simulated account or with very small trading size, so that you can just show yourself for the first say do it for 10 times in a row, and do it consistently, and then do it another 10 times. Do it at least 20 times in a row where you can prove yourself. I can take these system signals, and when my ego starts getting involved, I'll say, well, then reset the clock and start your count over about try another 10 times. Basically it's that process. And so most people want such instant results. They're not willing to go through the process of creating the right habits, the right discipline, the right behaviors, and therefore you're not giving yourself the chance to truly be around for the long term if you're not creating that kind of discipline. So it's a process, and most people don't like hearing that, but I'd say it's going to serve you better if you look at it as a initial education and journey and start small. You'll have the ability to then build, because trading, of course, is incredibly scalable. You can then take any methodology you prove on one contract at a time and then start moving it up gradually but steadily as you prove to yourself you can follow the system. So that's another thing, Mike, is it's about trust. You have to trust yourself at just a really core level that you can take your signals and that you know exactly when to get in and exactly when to get out. So many people are out there floating around without a true exit plan or an exit strategy, or they miss their exit, and then they're going, well, what do I do now? So then they get stuck in trades and trapped in trades. And so these are the kind of things where you say, look, if you should be out of a trade, I always say, just get out, even if it's worse than you originally knew you should be out. You should clear the slate. That's, again, another one of those things that's taking up your psychological and mental focus, is dealing with those problems. Kind of liken it, Mike, I'd like to joke about that old Verizon commercial, "Can you hear me now?" They were saying, okay, not getting good reception, can you hear me now? Well, it's sort of that same way when you start to have a small losing trade, and it's kind of gently tapping on the shoulder saying, can you hear me now? You say, that's not that loud to me. I'm not going to worry that much about it. And then it starts to get worse, and you say, can you hear me now? And you're like, I'm really not liking this. And then it's like screaming at you, can you hear me now? So basically, by that point, it's too late. The too much damage has been done when you hear that type of a sort of almost like a panic exit, sort of just like, get rid of it, I can't take it anymore. You know that you've let it go too far at that point. So anyway, bottom line is, I'm sure most traders have had that experience. Certainly I have in my earlier days of trading. And the bottom line is that the answer is get systematic, get discipline, and focus on that, because that, like I said before, that financial freedom attraction to trading comes with responsibility. If you take no responsibility for how you're going to get out of trades, no accountability to your success, then you're going to get yourself in trouble eventually. You may start off really well and think, this is easy, I should have quit my day job a lot earlier. But the bottom line is that there's a constant process you should be following. Otherwise, that if you're lucky on one end, you'll end up kind of seeing the luck go against you at some point. And if you're overcommitting your capital, you're just kind of asking for eventual trouble. So just take it slow and steady at first, and then you can build as you prove yourself that you can trust yourself to follow your system and the clear signals you're getting to get in and out. And if you don't have clear signals, you should wait to invest your capital until you get really clear entry and exit criteria, as well as the capital allocation criteria.
Yeah, I think that's really great advice for anybody who wants to start trading, or really anyone who's been trading and has been struggling. Well, Price, we're just about out of time, but before I let you go, I want you to talk a little bit about bigtrends.com and what you do there, and maybe talk about some upcoming events or projects that you're working on.
Sure, Mike. So bigtrends.com, we provide real-time trading alerts to folks that want to get specific, mainly options ideas sent out through different strategies that our systems are generating on an ongoing basis each day and each week. So we do send those out through real-time email and text alert, but then we've, of course, had a lot of demand for education. So we do coaching at Big Trends to help individual traders to, maximize their results, set a trading plan. If you don't have a trading plan, that's where we'll always start, is help you really build an effective trading plan. And then, of course, we're working with traders to get them more systematic, to be able to use TradeStation or whatever platform they're using. But TradeStation is often an area where I'm going to point somebody, if they're not clear about their trading approach, to say, okay, let's get really focused about how we're getting in, how we're getting out, and then building up the rest of the plan around that. And as far as projects, Mike, I'm always working on new things. We actually earlier this year had launched a FANG options trader that's done really well, because that allows you to focus on just 5 key names. So we focus on actually not just a traditional four FANG, Facebook, Amazon, Netflix, and Google, now parent company Alphabet, but we all know it as Google. And then, of course, we also add Apple in there. So that's been very effective because those 5 stocks have really driven a tremendous amount of the market gain at this point of the year. And even when the market trends down, you're going to see them typically really lead the way, I think, in both directions. And then for future projects, also, volatility levels. So if you look at the CBOE volatility index or VIX or other different measures of volatility are at relatively historic lows. And so when you think about what's the right option strategy to use when you're looking at low volatility, ironically, it's option buying. Most people that we talk to these days are just looking for that extra income, so they're going to the credit spreads and the other income generating strategies with options. But the interesting thing is that options buyers have a huge edge when you've got very relatively cheap premiums and you can find meaningful trends. So we're actually in the process of getting ready to launch a lower dollar option service where you can actually kind of take more of the sort of mega leverage mentality with that. So that's not for everybody. It's definitely a more aggressive approach, but it's an interesting way to take advantage of a low volatility environment. Certainly that's going to eventually change, but we're always looking at what the trading landscape shows you of where your edges are. And so, when everybody else is doing one thing, you probably want to be looking for maybe where's the surprise in that or the opportunity in that somewhere else. So maybe that's that contrarian instinct that's in me, even as a trend trader, to say, and once a trend is identified by everybody, it's probably too late. But a lot of times when the trend's getting started, you'll see it be initially sort of disputed or debated, and then only when everybody agrees that it's a great looking uptrend, it's probably at that point that you should be concerned. So bottom line is that, a lot of opportunities, a lot of great ways to keep testing ideas with TradeStation, and I'm just so grateful with the technology that you all provide. I want to thank you for such a great vehicle to frankly sort through what would be too much information overload if I was trying to just do it by hand. Ironically, when I got started, I was doing it by hand, and I had pages of potential trades, and guess how many I would make off of that? Almost none, because it was information overload. My brain was just completely saturated. Now I'm able to use radar screen and our TradeStation systems to go find the best of the best situations based on the probabilities and the edges that we look for any given strategy. So thanks, Mike, to you and your team. Keep up the great work.
Well, thanks, Price. And one of the benefits of working at TradeStation is getting to work people like you and the value that you bring to our customers. So again, right back at you. Thank you very much. Well, again, I want to thank Price Headley for spending this time with us today. This was incredibly great. And you can discover more about Price at bigtrends.com. And finally, I just want to thank everyone for listening to this podcast series. And be sure to tune in and subscribe to more of our podcasts. And of course, don't forget to visit our website at www.tradestation.com to learn more about our outstanding educational resources and online brokerage services. So thanks again, everyone. Thanks for tuning in, and have a great day. The preceding podcast was for educational purposes only. All of the symbols and trading ideas discussed were for educational purposes and were not recommendations. Active trading is not suitable for everyone. You can find additional disclosure information on the TradeStation website.